Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, I'm going to be analyzing Helmerich and Payne, ticker HP. This one came in by request down in the comments of one of my other videos. If you have a request, put it down in the comments. I will get the ticker up on the chalkboard behind me. I'm finally making some space up there, and eventually I'll make a video. I post about half of these videos over on the free tier over on Patreon, and then half here on the Confident Compounding YouTube channel. I also have weekly picks service over on Patreon for $25 a month. I share the best stock I can find each week. And so far, they're outpacing the S&P 500, but the S&P 500 gained a little ground on us this past week. As always, not individual investing advice, just how I analyze stocks. So, Helmerich Payne is an oil driller. So I actually have a somewhat interesting history with this stock. So let's go down to the description first. So engages in the provision of drilling solutions and technologies. So basically an oil driller, they're drilling the holes to get the oil. Let's get the fast graph up here. So I also have a 25% off affiliate link for fast graphs in the description as well. If you're interested in trying it out, they have free trials. So if you haven't used it before, you can get that discount if you use the link in the code or whatever. Which comes in very handy for cyclical businesses like HP here. So the story is, so this YouTube channel used to be called the Cyclical Investors Club. I still have a service on Seeking Alpha called the Cyclical Investors Club. And this is the stock that started my investigation into cyclical businesses, because I lost money on it back in, I think it was 2015. I forget when I think it was, the stock had sold off. Maybe it was in late 2014. But it was like 2014 to 2015 era, like right in here. The stock had sold off. The earnings still looked good. They had not fallen off a cliff yet here. And so the PE was like 10 or something, like I'm showing here. And I mean, this business has been around for, over 50 years. I think maybe they had paid dividends for like 50 years or something like that. It had a pretty good yield at the time. I can put those up here to give you an idea. Let's see. Let's do this one. Yeah. So the yield was up to, like, I want to say, like right here it says 5. I want to say it was like 4 or 5%. It was pretty enticing. And before these earnings fell, the earnings history just looked fantastic. So I'll try to show what that kind of looked like. So it looked more like this. And so we had the Great Recession, and that was kind of explainable. But the overall trend was the earnings were growing pretty decent, even since the peak in 2008, they had grown like over 50%. So that all looked pretty good. And then they had been raising the dividend, and it looked good, and they had a long history and all that stuff. So that's all the stuff I was paying attention to. And then the PE was cheap. And so I bought it. And then the price just kept going down. I think I ended up losing 30 or 35%. I mean, it wasn't a horrible loss necessarily, but it was sort of inexplicable to me as it was happening. Like, I just didn't understand why it was happening. And I was maybe chatting online or something about it. I hadn't started writing about investing yet, but I was on Seeking Alpha, and I was like, what's going on here? And at some point somewhere I read in a comment, somebody said, well, this is a cyclical business and earnings can fall a lot, cyclical businesses. And I was like, okay, so I spent maybe like 6 months, like really kind of trying to figure out what I had gotten wrong, because eventually the earnings did fall, right? By the time we got into 2015, we started seeing, like, toward the end of 2015, the earnings came down, and then the PE ratio doesn't look so good. It's like a 50 PE or something instead of a 20 and then 30, and then as the earnings go down, the PE goes up. So it didn't look cheap as much as it did. And so then I went and studied cyclical businesses, and I want to say Peter Lynch was probably gave me like the easiest explanation back in Beating the Street or One Up Wall Street. I forget which one it was, which book it was. I think he probably talks about him in both. The example he used was Ford, and so reading that, then I kind of got it and I understood. So my next question that I asked myself was, well, can I make money off this? Because clearly I'm not the only. I mean, there were all these other people that were buying the stock during this peak, right? And I didn't do that. I waited till it got cheaper, but didn't really understand what was possible. And so I spent, 6 or 9 months working on a strategy to invest in these deeply cyclical businesses that were still pretty high quality, which I considered these guys at the time. And I started implementing it in late 2015 and writing about it in like early 2016 on Seeking Alpha. And that's when I started just part-time writing about investing. It would be a couple more years before I did it full-time. But that was my first strategy that I developed myself, and it worked pretty well. Usually about 4 out of 5 times I was getting, doubles, and maybe the fifth or maybe 3 out of 5 times, and then like 1 out of 10 would go completely belly up and lose a lot of money. But I was able to get enough data points over the 5 not even 5 years. It only really took like 3 years because we had kind of a downturn in 2016. So I had a little industrial recession to work with that helped. And then in 2018, there was kind of another peak, not so much for oil, but for a lot of industrial stocks. And I got really bearish on all those at just the right time and kind of got that peak about right. And then I started doing it full time. But this is the stock that started it all. So what do I think about it? One, we can see what earnings did here. And if we had a chart that went back far enough, we would see that in early 2000s, they did something similar, right? You can see it's coming out of a downturn. And if you went back to like the 1980s or whatever, you would see another big down, like a giant super cycle downturn, more like this one that we had in 2015, or that started around there. So my definition of a cyclical business for practical purposes is when earnings fall 50% or more during a downturn and then eventually recover, right? A bad business can have earnings decline 50% and then never recover. And in that case, that wouldn't really be a cycle, right? A cycle is earnings come down, but then they come up and make a new high. So 2008 period here would be they probably fell 50% or close to it. I'm going to shrink this so we can see. There we go. So not quite. I mean, they peaked at $4.07 and bottomed at $2.66 on the adjusted earnings. Let's see what basic earnings look like. There we go. That's more like it. So without the adjustments, earnings fell more like 75% or something like that during that downturn. And the stock price fell accordingly. Trying to get the bottom here, about 75%. Okay. Now it anticipated the fall in the coming years is what happened there, and just kind of general panic. So this kind of pattern right here shows a form of cyclicality. Earnings fall down, they come back, and then they make a higher peak. All right. Now with oil and gas and drilling, they also have these big super cycles that happen from time to time. There was one in the 1970s during the upcycle with, the oil embargo and all that. And that, I want to say that peaked out maybe in the very early 80s. And then we had a bad commodities super down cycle, right? We think of like farms and oil companies. A lot of those commodities that are tied to that were going bankrupt. Wiped out a lot of oil companies too back in the 80s. So that was a big down cycle, and then it was just kind of still recovering from that for like 20 years, basically. Maybe even more than 20. And then we had the fracking boom, and that's what all this fracking required a lot of new drilling. These guys drill, and so they participated in this super cycle. And then it ended in like 2013 or 14, and then the results kind of came in the coming years after that. So the reason that's kind of important to note is the earnings that we had in 2023 here, this earnings peak was not as high as the peak in 2014 or 13. And so that would lean a person to say, okay, maybe that's not a high quality company, like a real cyclical company, because how many years went by? 1, 2, 3, 4, 5, 6, 7, like 7 years went by. They had an upcycle that was short, didn't even reach what it was back then. I think that's a legitimate thing to consider and think about, but I wouldn't be too hard on the quality of their particular business, because usually if you have a giant super cycle, like if you think of the tech bubble in 2000, like the big super cycle there are stocks like Oracle, Cisco, right, who maybe just now are recovering like 20 years later or something like that from the peaks. So, but they've still been solid businesses. It's just the cycle was way too big to ever recover so quickly within just 7 years. So I wouldn't put it this way. Normally when I would see a stock earnings chart like this, if I didn't know that it was a super cycle back here for whatever the business was, I would normally say that's probably too low quality for me to even consider as a cyclical. I wouldn't quite go that far with these guys, but I would say it's kind of borderline. Like that's at least kind of out there, because I think the way I would frame it is they're in a super down cycle right now, and it's really hard to know when that bottoms and starts to recover again consistently. Like there's a recovery here in 2016, there's a recovery from 2021 to 2023, but the trend, as you can see here, is down and to the right for earnings and the stock price. So if you were to look at some similar chart from 1978 or something until, how many years is this? Like 12 years. So until 1990, it would look probably not too dissimilar to something like this. And eventually oil comes back and drilling comes back. But it can take, who knows when it's going to happen is the problem. We just don't know when the next kind of fracking style boom will happen. And I mean, it would almost, I think, take some sort of geopolitical event, like significant event for that to happen, for there to be some sort of big oil price spike, akin to the 1970s. I think for that to really get really good gains, like 100%, 200%, which is what you want in a cyclical business, because they're more volatile and honestly more, sometimes and often, more risky. So obviously if you have big years where you're losing money like this, and it looks like they're expected to kind of be marginally making money the next few years, then that means there's more risk probably. So like more real risk, not just market volatility. And so that's why I would probably not be a buyer of this, just because the upcycle is too hard to predict. So if I was going to go into the oil industry, you have the two big ones, obviously, Chevron and Exxon. We'll look at Chevron's numbers, which you can see have a somewhat similar pattern, except for their earnings did actually reach the 2011 peak and surpass them. And the down cycle wasn't quite so bad, right? And they didn't cut their dividend, it doesn't look like. But they are still in the same general down cycle that HP is in. Exxon is probably going to look pretty similar. XOM, right? So kind of similar to Chevron, maybe a little deeper drawdown when oil was negative money. And so you can kind of see the difference in the patterns of the earnings. So I think in a deep down cycle, those are the two you kind of want to, if you're going to take a chance on them. ABBA, is that ABBA? and you can get, a 200% return or something like that, plus, and then it might be worth just buying and holding if you can get it super cheap. The other group that I like, in particular, I do like Valero. I have videos on here where we bought it. I bought it back in 2020 a couple times. Took profits somewhere around here, I think. Did really well with it. It had an even crazier jump up that's back down to normal. Dividends are, people have kind of locked into this one for the high dividends, which it used to be high. I think it was 7% when I bought it and 2.5% now. But if it sells off and gets cheap, let's get rid of that for a second and kind of throwing everything off here. So it's actually near all-time highs right now. But let's say on a dip like this, which just happened earlier this year, 104, it's almost doubled since then. If it got a little bit cheaper than that, this would probably be where I would go to buy instead of going to the HP, instead of going to like drillers. I've had bad luck with drillers and servicers, like Schlumberger, unless they change their name. I don't know. I haven't looked at it for a while. Whoops. Yeah, I think maybe they changed it to something. Halliburton is another one. There we go. So if we pull up, so this is more like oil services. I like the refiners better, so you can see a lot more, like a lot of volatility. They get cheap, which is nice, but if you don't get the cycle right, I mean, you can lose so much money. So again, I won't pick the very top, and we won't pick the very bottom, but let's just go there to like there. Like you're down 65%. I bought some of the servicers when they were down, I think down here. Looks like Halliburton eventually recovered a little bit. But they're just kind of down the food chain in terms of like where the money's flowing. And I feel like the Chevrons and the Exxons control, a little bit more of how the money's being spent. I am long Oxy still, which I've talked about here, but pretty bearish on it too, honestly. So it's at least over the next 2 or 3 years. Again, we see kind of this similar pattern where we did get a higher peak, but the trend right now is just still down. We're down to like pre-COVID. Well, it didn't bottom until after COVID started. So we don't know where the ultimate bottom is. Again, these down cycles can be like really long. So to me, I just kind of put all these pretty much in the too hard category. The only thing I would say is at the portfolio level, which was the case that I made for Oxy and Devon a couple years ago when I relaunched the YouTube channel, is if there is danger of like an oil price spike, which I think there was more of a danger under Biden in the way that he was going about countering Russia compared to Trump, who was more concerned about keeping oil prices low, I would say. So for the next 2 or 3 years, unless there's a major oil crisis of some kind, it's really hard for me to see how you make like really good medium-term money that you would want to make in an oil stock for it to play it purely as a cyclical, which would mean I would want at least 100% upside potential. It's not that it's impossible. What are we at here? 70 and down to 40. So if it got down to 35 and you could get back to this peak, that would be a 100% return. But the question is how long it takes. And there just isn't much catalyst right now. So even though I hold this one, it's really more for portfolio balance, and I maybe should have sold it when the administration's changed. But I just kind of kept on holding it to see what happened with like global oil supplies and things like that. There's a lot that could have happened. There's a lot that still could happen. But it doesn't look like anybody wants to really create a new, oil crisis at all. So I would say I'm pretty bearish on almost all these stocks right now, even though I own a couple of them still. And HP is down the list. I would say they're marginal quality compared to even some of the others that I've shown. So maybe on the upswing, if you had a bunch of cash left over and it looked like oil prices were picking up and it really looked like they could sustain that, might be 3 years from now, might be 4, might be 5. Really hard to say. But I would probably wait for evidence of that starting and actually rolling before I jumped in any of these right now. All right. Hopefully you guys found that somewhat useful. If you did, hit the like and subscribe button. And don't forget to check out the free tier over on Patreon. And I'll see everybody later.